But we also think it's important to look at these things and try to understand the limitations of short-term forecasting. So to start, maybe I'll just read this Jim O'Shaughnessy quote, which is what you had in your article. And so O'Shaughnessy said, "And so from our perspective, trying to make a successful forecast, short-term forecast is virtually impossible because in the short term, there's quite a bit of noise in the marketplace, and people mistake noise for signal, and they have a narrative about it, and it's very believable, but unfortunately often wrong. So we don't make forecasts in terms of what the market's going to do over the short-term periods of time because, quite frankly, we don't know. And if others were honest, they would have to admit that they don't know either." Most market forecasts are made out of self-interest, and so the goal oftentimes is to benefit the forecaster, not really the investor. And so what you did in your article is you kind of came up with, I think, 4 or 5 different types of forecasts that, we often hear. The first one is starting with, the calendar year prediction. And you looked at different investment banks, price targets, and so on. So, maybe let's start with that one and just talk about what goes into it and talk about, why this is so difficult to do, and yet, every major Wall Street investment bank and a lot of other people still decide to do it.
Yeah, like you said, everybody wants to make short-term predictions in the market, and most of that is for their own benefit and for marketing purposes and things like that. But investors can sometimes be trapped by that because sometimes they can see these predictions and they can want to act on them. They can want to change their portfolio, and that can be very dangerous. So what I wanted to highlight with the article is the types of predictions you should look out for and beware of, and also, I wanted to get across an understanding that most of the things people are predicting about the market, unless they're predicting them over 20-plus year horizons, most of those things are not actually predictable. So they don't actually know the thing that they're predicting. And like you said, the first one I came up with was the calendar year projection. And we just saw those. We're recording this in late January. We just saw everyone come out with their year-end S&P 500 forecast for 2020. And if you look back to 2019, and you look at all the major banks and all of their year-end forecasts, the highest one was 3,100 on the S&P, and the S&P closed the year at 3,221. So none of them were even close. And I don't blame the people making the forecast. It's part of their job. It's something they have to do. But it's just important to understand that these forecasts, are more entertainment than they are valuable. And also what you'll notice with the forecasts is the market produces, around a 10% return long-term. All of these forecasts will be somewhat close to that. Because from a careerist perspective, it doesn't make sense for an analyst at a major bank to predict, a 30% increase or a 30% decrease in the market. Because if they're wrong, they're going to probably lose their job. Right. So most of these are between, say, 0 and 12% every year. And they're good for entertainment purposes, and they're good for, you can read the details behind them to understand what's going on with the market, but they should just play no role in how you're building your investment portfolio. Mm-hmm.